Hi everyone, welcome back to the channel. When most people hear quantum computing, they think of something futuristic, experimental machines in physics labs, decades away from practical use. But here's what's interesting. Major financial institutions are already investing heavily in quantum research today. Not because quantum computers are replacing classical systems tomorrow, but because finance is one of the few industries where quantum computing could create measurable impact early. To understand why, we need to look at how modern banking actually works. At its core, finance is a computational industry. Banks don't just store money. They model risk, they simulate markets, they price derivatives, they optimize portfolios, they detect fraud in real time. And almost all of these tasks rely on large scale probability calculations. Let's start with risk modeling. Banks constantly estimate potential losses under thousands, sometimes millions of market scenarios. They simulate interest rate changes, market crashes, currency shifts, credit events. One of the most common tools for this is something called the Monte Carlo simulation. The Monte Carlo simulation runs huge numbers of random scenarios to estimate possible outcomes. The more scenarios you run, the more accurate your prediction. But there's a problem. The computational cost grows quickly. As financial instruments become more complex, especially derivatives tied to multiple underlying assets, the number of variables explodes, and classical simulations can become extremely expensive in terms of time and processing power. Quantum computers are naturally suited to certain types of probabilistic sampling problems. Some quantum algorithms suggest potential speedups in Monte Carlo style simulations, which could mean faster and potentially more precise risk estimates. Now, we're not there yet in production. Current quantum hardware is still noisy and limited, but banks are actively researching whether quantum enhanced Monte Carlo methods could eventually outperform classical ones. Next, let's talk about portfolio optimization. Imagine you're managing a portfolio of thousands of assets. You want to maximize return, minimize risk, stay within regulatory constraints, maintain liquidity requirements, account for correlations between assets. The number of possible combinations grows exponentially as assets increase. This is known as a combinatorial optimization problem. Quantum algorithms like the quantum approximate optimization algorithm, often called QAOA, are being explored to see if they can handle certain optimization problems more efficiently than classical heuristics. Even small improvements in optimization can mean millions of dollars in performance gains at scale. That's why banks care. Another area under active research is derivative pricing. Many financial derivatives, options, swaps, structured products depend on solving high-dimensional mathematical equations. Some quantum algorithms, such as quantum amplitude estimation, theoretically offer quadratic speedups over classical Monte Carlo approaches for specific pricing tasks. Again, these are experimental efforts today, but financial institutions are not waiting for perfect hardware. They are building internal expertise now. This leads to an important clarification. Banks are not running your savings account on a quantum computer. What they are doing is running proof of concept experiments. They are partnering with quantum hardware companies. They are building internal quantum research teams. They are testing hybrid algorithms that combine classical systems with small quantum subroutines. And in many cases, they are developing what are called quantum-inspired algorithms. These are classical algorithms that borrow mathematical ideas from quantum computing, such as tensor networks or advanced optimization heuristics, to improve performance on today's hardware. In some cases, quantum-inspired methods have already shown measurable improvements without requiring quantum machines at all. Now, let's talk about security. This is the area that gets the most headlines. Much of today's financial infrastructure relies on public key cryptography. Systems like RSA and elliptic curve cryptography, large-scale fault-tolerant quantum computers could eventually break certain widely used encryption methods using algorithms like Shor's algorithm. That's not happening today, but banks think in decades, not quarters. That's why financial institutions are also investing in post-quantum cryptography, encryption methods designed to resist quantum attacks. In other words, banks are preparing both to use quantum computing and to defend against it. There's also fraud detection and anomaly detection. These rely heavily on machine learning and pattern recognition across massive datasets. Researchers are exploring whether quantum machine learning algorithms might eventually provide advantages in high-dimensional pattern analysis. This remains highly experimental, but it's another active area of study. So why is finance one of the first industries deeply engaged in quantum computing? Because the economics justify it. If you can improve risk forecasts by a fraction of a percent, optimize capital allocation slightly better, detect fraud a few milliseconds faster, price complex derivatives more efficiently, the financial upside is enormous. Finance operates on thin margins at massive scale. Small computational improvements translate into significant competitive advantage. But it's important to stay grounded. We are still in the early stages. Current quantum computers are limited by decoherence, noise, and scale. Error correction remains one of the biggest technical hurdles, and no bank is replacing its classical infrastructure anytime soon. The near term reality is hybrid systems. Classical supercomputers will continue doing most of the work. Quantum processors may eventually serve as accelerators for specific subproblems, similar to how GPUs accelerate certain AI workloads today. That's the real model. No replacement, specialization. The key takeaway is this: quantum computing in banking today is about research, experimentation, and strategic positioning. It's about building internal capability early. It's about understanding where quantum might provide advantage in the future. And it's about preparing security infrastructure for a post quantum world. Finance isn't adopting quantum because it's trendy. It's adopting quantum because the hardest problems in finance look a lot like the kinds of problems quantum computers are theoretically designed to solve. And in an industry where computational edge equals competitive edge, no serious institution can afford to ignore that possibility. If you found this helpful and want more real world applications of quantum computing, not just theory, like the video. And if you want deep, clear explanations without hype, subscribe and stick around. There's a lot more happening beneath the surface of quantum computing than most people realize.